I'm here with executive editor Steve Ehrlich about an article that he wrote this week. Steve, you covered the crypto treasury companies trend with an interesting angle, and it was about how the executives are being compensated. So, one of the first points that you mentioned is just what a significant premium some of these crypto treasury company stocks are trading at compared to their crypto holdings. So, what factors beyond just executive influence do you think are driving these elevated valuations?
I think it really just comes down to FOMO type excitement. Uh, Crypto, I mean, as we both know, Laura, and we've both covered, crypto loves a good fad, a new trend. Used to be like DAO tokens, it could be DeFi, NFTs, meme coins. And it really seems like today it is the crypto treasury companies. Frankly, I'm a little surprised it took so long for this many people to start following the Michael Saylor playbook. But that's really what's happening here. And these companies are launching with sometimes like 9 or 10 figure bankrolls to pretty much buy Bitcoin and sit on it. I mean, granted, there are some differences between the companies and their strategies. I mean, they're promising to use capital markets efficiently to acquire Bitcoin, or Solana, or Ethereum, or XRP faster than some of the other competitors. But it really just comes down to uh, a lot of excitement over these particular companies, and I think it also just kind of it's probably a little bit of a warning sign for investors that we're getting perhaps a little too frothy in all of this.
Yeah. So, one of the things that you talked about was how these companies are compensating executives. And you had an example of one that follows kind of a more conventional model. And then you had another example of one that tries to be or is trying to be different and more innovative in how it's compensating its executives. Can you talk us through those two examples?
Yeah, I was thinking about this question because it kind of follows along with an earlier story that I wrote that kind of explored potentially the risks that these types of companies can pose to the entire crypto ecosystem. There are naturally going to be incentives for these companies to leverage the balance sheets, try to be creative in how they use the crypto that they hold to generate profits and value. And it got me wondering, well, how are they sort of incentivizing their executives? Are they incentivizing them to be as risky as possible to grow at all costs, or are they trying to be a bit more measured in looking for sustainable long-term growth that aligns the interests of the shareholders and the executives? And when I started looking into this, because you can look up SEC filings and you can see exactly these are all publicly traded companies, so or at least the ones that have been traded for a little while. The newest ones, Nakamoto 21, those haven't actually released this information yet, and those companies declined to provide it to us. But I mean, you can see that there's different ways of compensating executives. One firm, Apexi, that is focused on Solana, their CEO makes, I believe, about $835,000 salary, but has an options grant that right now I believe we report is worth over $10 million in at least paper gains, because he was able to purchase I believe it was 500,000 shares at a price of $2.28, which is where the stock was a day or two after they announced this Solana Treasury strategy. And as of yesterday, when we wrote the story, the stock was up to $10.95. So that's a huge gain in a very short period of time. And his stock compensation is heavily weighted towards options. Now, this can be good, but it's also risky because options are basically worthless until they're worth something. Some other companies, like Strategy, for instance, they compensate their executive in a different way. They have cash bonuses for performance. They have performance bonuses for stock bonuses based on meeting certain performance goals. And then they also have restricted stock units, which are basically shares of equity that vest over time and then are given at the current market price. So those stocks, theoretically, you can lose money on those stocks as well. So there are these different options there. So I found that the Apexi strategy was actually very risky. But what the article centered on and what I found most interesting was another Solana company called the DeFi Development Corporation. And they are eschewing all of that. And instead, they structured their executive bonuses around whether or not they're able to increase the amount of Solana they hold per share to meet certain thresholds by this time next year. The bonuses are going to be paid in cash. And when I interviewed their CFO, John con for the story, he basically said that he felt that we should not benefit financially as individuals from just the price of the token we're holding appreciating. Like there should be some measurable goal that investors can track and see how efficient we are as a marketing team. So I found that particularly interesting, and I wanted to then look at two things. Like one, is this going to be a trend that other companies can follow? And two, how um, is this the best way to compensate executives?
Yeah, and there were some interesting numbers in there. So they kind of gave what the current Solana per share amount is, and they wanted to double it. But then there were even incentives for doing more than that. And it kind of looked a bit challenging, but who knows? Because they don't really know, what this is going to look like. It's unclear. What did you think?
It's a little. I think the goal that they have right now is to double the current number, which I think is like 0.04 or something like that. But by the time people watch this video, that number could certainly change. He told me that if they could not double that by this time next year, they did not deserve bonuses. And then there's two tiers above that where I think they can max out at about 200% of the bonus. I believe their CEO, Joseph Honorati, his salary is somewhere around in the mid 500,000s, and his bonus would be, I think, 65% of his annual salary. So he could get as much as two times that. So it was pretty interesting. I mean, there's always ways for people to sort of massage the numbers and try to make them look where they need to be in order to reach certain goals. I mean, the company could, I don't know, theoretically try to borrow Solana from someone else, and therefore you don't dilute the shareholders, but you have more Solana. I mean, that's just for instance. I didn't ask them that, but there's certain things that can be done. But then at the same point too, I mean, some of these executives that have either restricted stock units or options, I mean, they could also increase the share price through things like buybacks, even if that's perhaps not the best use of corporate treasury, et cetera, to shrink the circulating supply and accelerate the price. So there's lots of ways that all this stuff can be done. There's no foolproof way. But again, the assertion, at least from the DeFi Development Corporation executives, is that this is at least more straightforward and transparent than just giving a ton of option bonuses to executives that are launching these companies in the middle of a Fed.
Yeah. The one thing that I was thinking about was Jack Mallers of 21 also has been talking about different metrics, Bitcoin per share and stuff, but we don't know whether or not that's going to be tied to his compensation. So yeah, some of these companies right now, 21, Nakamoto, that have this buzz, they haven't revealed what they're going to do.
Yeah, and to be clear, we asked, and they either declined to respond or do not respond at all, because it's very easy and good to say this is how we're going to grade ourselves, but that doesn't mean we'll find out how they really grade themselves when their compensation deals are publicized.
And last question, just when you look at TradFi, are there any comparisons there that you think would be helpful for how people should think about this?
Yeah. So in reporting this article, which I found really fun to do, I spoke with a number of experts in executive compensation, which is a much bigger field than I even imagined it was before, because there's so many things that go into it. And I mean, the best practices I saw were usually finding like multiple different types of bonus structures tied sometimes to stock goals, sometimes tied to certain performance goals, so on and so forth. I mean, one of the strategies that came out of my discussions mirrored what I said earlier about how strategy does it with their current CEO, Fang Li. Basically having a diversified set of equity bonuses so that you can sort of manage the short or blend the short and long-term incentives. But really what kind of came out once I explained how these companies work to these individuals, and they didn't really know anything about these companies before I brought it to their attention, they said the best thing you can do is try to figure out a metric that can judge or assess the effectiveness of the management team. And the metric that kept coming up over and over again is premium to NAV. How much more is the company trading beyond just the value of the crypto on its balance sheet. And Laura, we looked at these numbers; they're all over the place right now, and especially for some of the new companies because they are so new, they'll come down. But some companies are in the 80s, some companies are in the 1.5, some companies are in the twos. Strategies at 1.7. The Solana companies are around 5 or so. And they're saying that they're going to be efficient at acquiring crypto. They're going to do it faster than people can do it themselves. And these executives say that's worth a premium in the stock price. Well, how much? That seems to be the metric that matters most to these people. And in the traditional world, they said that this has a lot of similarity to something known as price to book, which at least in terms of financial companies like banks, et cetera, that looks at how much investors value the company beyond just the company's assets, deposits, et cetera, et cetera. And I actually looked at least one broad banking index, the KBW banking index, and the average price to book ratio for that, for entities in that index is 1.44. So I thought that was just an interesting benchmark. But that seemed to be the metric that resonated with all the experts that I spoke to for the story.
Yeah, that Nakamoto one is trading at like 56 times.
Yeah.
So clearly, there's some inefficiencies right now. All right, Steve. Well, this has been super informative. Thank you so much.
All right. Thanks, Laura.